Till now, we have covered chapter 1 to chapter 7, including it practice. We have covered some accounting standard IAS 16, property, plant, and equipment, IAS 23, borrowing cost, IAS 20, government grant, IAS 40, investment property, IAS 36, impairment of asset. What else? IFRS 5, asset held for sale and discontinued operation. What else? 38, intangibles. So these accounting standards we have discussed so far. Chapter 8, in chapter 8, name is other standards, meaning in this chapter we will study 3 more accounting standards. Let's discuss. In fact, 4 accounting standards in this chapter. We'll study IAS 8, we'll study IFRS 13, IAS 2, and IAS 41. 4 accounting standard we are going to study in this chapter. So first standard is IAS 8. The name of IAS 8 is Accounting Policies, Change in Accounting Estimates and Errors. Accounting Policies, Change in Accounting Estimates and Errors. Mainly there are 3 topics in this chapter. One is a change in accounting policies. Second is change in accounting estimate. And third is prior period errors. Accounting policy change, accounting estimate change, and prior period errors. So let's discuss the main theme of this standard. If company is changing its accounting policy, if company changing its accounting policy, like in the past, they recorded their asset on historical cost basis. Now they are moving towards a fair value basis, current cost basis. This is called change in accounting policy. In previous, they record their inventory, they measure their inventory on a LIFO, last in first out basis, or first in first out basis. Now they are going to measure their inventory on AVCO, average cost basis. So that is called change in accounting policy. If you are changing accounting policy, you need to provide a disclosure in the financial statement for that change, where in notes to the accounts, and there should be retrospective effect. Retrospective effect. What does mean by retrospective effect? Prior year adjustment. Not only you need to provide a disclosure in the financial statements, there should be prior year adjustment. Mean the policy that you have changed relating to suppose any asset. In past, how many years you have used that asset according to previous policy? What could be the effect if in the previous year the same policy prevailed? So you need to adjust the opening balances, mean the figures coming from prior period. Mean you need to adjust the comparative. Comparative mean prior year figures. And you need to provide a disclosure in the financial statement. In case of accounting policy change, disclosure is required as well as retrospective effect, mean prior year adjustment. If company is changing accounting estimate, what is estimate? Like depreciation rate, depreciation method, useful life of the asset, residual value of the asset. Like company is going to change useful life of the asset, or residual value of the asset, depreciation rate of the asset, depreciation method of the assets. So you need to provide only a disclosure in financial statement. No prior year adjustment is required in case of accounting estimate change. Can you understand this? Or you can say you need prospective effect. What is the prospective effect? Prospective mean relating to future. Mean from now onward, you will prepare financial statements using the new estimates. Obviously, automatically, the new estimate will prevail in coming year financial statements. Don't need, yeah, that will remain same. Don't need to adjust opening balances. In case of policy change, prior adjustment is necessary. Mean you need to change the comparatives. But in case of estimate change, no prior adjustment is necessary. Just need to provide a disclosure. Even if we don't talk about prospective effect, it's fine. Obviously, the new estimate change will be reflected in future financial statements. Just to differentiate what is meant by prospective effect, just what is meant by retrospective effect. If there are any prior year errors, there were any prior year errors that you are going to correct in current year financial statements. So you need to provide a disclosure for that correction, as well as the retrospective effect should be met. And you need to rectify the error in how many years and its effect on the opening balance. Can you understand this? The accounting treatment. Let's study what is mean by accounting policies. What are the examples of accounting policies change? What are the examples of estimate change? So we need to read something. Mean from accounting point of view means solving numerical question. This is enough. But you will face MCQs relating to theory as well. So let's study the standard in detail. Okay. So what is mean by accounting policies? Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statement. In the policies, the rules company adopted to prepare and present financial statements are called accounting policies. Whether we gonna record asset on historical cost basis or revaluation basis. IAS 8 require an entity to select and apply appropriate accounting policies complying with IFRS. Mean accounting policies should be appropriate as per IFRS. Mean you need to see whether this policy allowed by the standard auditor. And interpretation to ensure that the financial statements provide information that is relevant to economic decision making need of user and reliable in that the financial statements. Mean whatever the policies you have adopted, that should be relevant to the need of user, and that must be producing reliable financial statement. What is meant by reliable financial statement? Mean financial statements should represent faithfully the financial position, financial performance, and cash flow. Reflect the economic substance of transaction, mean economic reality rather than legal reality. Are neutral, mean free from bias. Are prudent. Prudence mean future expenses should be recorded immediately, but future income should be recorded when they occur. Are complete in all material respects. Reliable financial statements mean faithful, economics reality, economic substance, neutral, prudent, and complete. Now, let's discuss what is change in accounting policy and what is its accounting treatment. The general rule is that accounting policies are normally unchanged, mean companies should not change the accounting policy year on year basis. But if there is any requirement or you are going to change, what should be the accounting treatment? From period to period to ensure comparability of financial statements, because if you are changing policies every year, financial statements will not be compared with previous year properly. IAS 8 requires accounting policies to be changed only if the change is required by the accounting standard or result in financial statements providing reliable and more relevant information. Mean by changing the accounting policy, we can produce more reliable and relevant financial statements. Then you need to change the accounting policy. Otherwise, accounting policy should not be changed year on year basis. When accounting policy should be changed? When it is required by accounting standard, mean there is change in accounting standard, or when by changing the policy, you can produce more reliable and relevant financial information. A change in accounting policy occur if there has been a change in recognition of the asset, presentation, or measurement basis. When accounting policy should be changed? When there is a change in recognition, when there is a change in presentation, and when there is a change in measurement basis. What is meant by recognition? An asset is now recognized rather than an expense is now recognized rather than asset. Like previously, borrowing cost relating to asset, we were charging as expense to P&L. Now suppose standard says no, you can capitalize borrowing cost relating to the asset. So this is recognition change in policy. Our policy can be changed due to presentation. For example, depreciation is now included in cost of sale rather than admin expenses. I mean, those machinery which are used in production, their depreciation should be charged to cost of sale rather than operating expenses. The assets which are not used in production, their depreciation should be charged in operating expenses. But the asset which we are using in production process, their depreciation should be part of cost of sale. I mean, before you are charging depreciation of all type of asset to operating expenses. But now you have decided no. The asset relating to production, their depreciation should be part of cost of sale. So this is change in accounting policies, because through this cost of sale figure will be higher and operating expenses will be lower as compared to previous year. This is presentation. Means you are still charging depreciation. But to present depreciation, now you are presenting under cost of sale rather than operating expenses. I mean, this will be having a big impact on the gross profit. Measurement basis, for example, stating asset at replacement cost rather than historical cost. In asset measurement will be on current cost model, revaluation model rather than historical cost model. Or inventory measurement is on AWACO rather than FIFO method. That is also called measurement basis, mean how inventory should be measured, not on average of inventory. It should be measured on first in, first out basis. In the unit coming first in the storeroom should be sold first, should be out first. The units coming at the end should be included in closing inventory figure. So accounting for change in accounting policy. The required accounting treatment is that the change should be applied retrospectively, prior year adjustment, with an adjustment to the opening balance of retained earning in the statement of changes in equity. You need to adjust the opening balance, and due to that, there could be some income or expense. So that income and expense was recorded in profit previous year, and those profits are where in retained earning. So you need to adjust the retained earning. Comparative information should be restated unless it is impracticable to do so. Mean prior year figure should also be restated. If the adjustment to the opening retained earning cannot be reasonably determined, mean what could be the effect due to change in policy in retained earning, opening retained earning, that figure cannot be determined properly, then the change should be adjusted prospectively, included in the current period statement of profit and loss account, and so on. Prior adjustment means you need to adjust the prior period retained earning. But if you cannot calculate the figure by how much amount we need to adjust the opening retained earning, that figure is not easy to calculate, then there shouldn't be any prior adjustment. Just provide a disclosure, and this policy should be followed for current and coming years. But that is in very rare cases. What's the normal accounting treatment? There should be retrospective effect as well as disclosure. So what is the accounting treatment of accounting policy change? Disclosure in the financial statements as well as retrospective effect. Retrospective effect means opening retained earnings should be adjusted due to change in policy. What could be the change in expense, either increase or decrease? That should be adjusted in prior period's profits. Where is prior period profit? In opening retained earnings. And comparative mean previous year figure should also be changed as per the new policy. Accounting estimates. Accounting estimates are monetary amounts in financial statements that are subject to measurement uncertainty. Many figures in the financial statements require some form of estimation, where monetary amounts cannot be directly observed. We need to depreciate the asset over its useful life. Can we estimate exact, accurate useful life? No. We can just make a guess. We can use this asset for 10 years. We can use this asset for 5 years. That is called estimation. What will be the residual value after 10 years when you finish and sell the asset? After 10 years. Can you calculate exact amount, residual value? No, you can make a guess. Like according to today market, similar asset, 10 years old, we can sell at this amount. So might be after 10 years, we'll be able to sell this asset by this amount. Is that? And these estimation could go wrong as well. Because these are estimates. These are estimates. The development of such estimates would require the use of judgment or assumption based on the latest information available. Warranty provision. If you are providing a warranty to customer, you need to create warranty provision in the financial statement. Mean there will be warranty claim that you will face in future. Mean there will be some expenditure that you need to pay back to the customer. And prudence says future expenses should be recorded now. This means you need to create warranty provision in the financial statement. By how much amount? That is estimation. You cannot calculate exact. In previous year, we received warranty claim of say 70,000. But previous year sale, current year sale will be same? No. If sale remains same, okay, 70,000 provision is fine. If there is increase or decrease in sale as compared to previous year, you need to change this warranty provision. That is estimate. These accounting estimate could include depreciation expense according to useful life, according to residual value, fair value of an asset or liability. You cannot measure accurate The fair value you can measure accurate while selling the asset what you are receiving. Otherwise, you can just make a guess. Net realizable value of inventory. At what amount you will sell the inventory and what will be the expenses. Expenses, selling cost, also include delivery cost. Delivery cost depends upon fuel prices. Fuel prices changes every month. So you can make a guess on it. That is estimate. Changes in accounting estimate. Effect of change in accounting estimate should be included in the statement of profit or loss in the period of change, and if the subsequent period are affected in those subsequent period. I mean, you have changed the depreciation rate method where that depreciation will move in statement of profit and loss account. And there shouldn't be any retrospective effect. There should be prospective effect, means subsequent. I mean, this estimate change will be reflected in future financial statements as well. I mean, you will calculate depreciation using these estimates. Effect of change should be included in some income or expense classified as was used for the original estimate. I mean, if you were charging depreciation before under operating expenses, now due to change in depreciation rate method, you will still include depreciation under operating expenses. But if as per new estimate, you're gonna record depreciation under cost of sales, so that is policy change. And if change in estimate is material to the financial statement, mean effect on financial statements is material, mean the effect on financial statements is 10% or more of profit. That is material. In that case, you need to provide a disclosure in the financial statement as well. And normally estimate change are material to the financial statement. What are the examples of change in estimate? Changing useful life of non-current assets, method of depreciation of non-current assets, very important point. Changing depreciation method from reducing balance to straight line to reducing balance, that is estimate change, not a policy change. Changing measurement of inventory is a policy change. But changing depreciation method is a estimate change. Through depreciation method, you are not changing the measurement of asset. You are still depreciating. Just the pattern of calculation has been changed. Just the pattern of calculation has been changed. You are not changing the measurement of asset. According to previous method, you are calculating asset measurement cost less accumulated depreciation. You are still calculating carry value cost less depreciation, only the depreciation calculation pattern has been changed. That's why it is called estimate change rather than policy change. And normally in a 90% accountancy related interview, the interviewer asks this question: whether the change in method of depreciation is a policy change or estimate change. Whether the change in measurement of inventory method is estimate change or policy change. Warranty provision based upon more up-to-date information about claims frequency and values, like if your sale has increased, ultimately you need to change the warranty provision. That is estimate change. Illustration 1. If a non-current asset has depreciable amount of 5,000 to be written over of over 5 years, different depreciation methods such as a straight line, reducing balance, etc., all represent different estimation techniques. The choice of method of depreciation would be the estimation techniques, whereas the policy of writing off the depreciation amount of non-current assets over their useful life would be the accounting policy. I mean, previously you are not depreciating, now you have started depreciation, that is policy change. Estimation techniques therefore implement the measurement aspect of accounting policy. And this is a just pattern of calculation. Illustration 2. For each of the item, ask whether this involve a change to policy or change to estimate. Good luck, everybody. 1, 2, 3, 4. You need to identify which one is policy change, which one is estimation change. Case of recognition change, presentation change, measurement basis change, that is policy change. Which one is policy change? Which one is policy change? First and four only. First four, then. First and four is policy change. Third also policy change.
Second one is estimation.
Second is estimate change. Third also. Third also policy change or estimate change. Okay. So first one, an entity has previously charged interest incurred in connection with the construction of tangible non-current assets to the statement of profit or loss. Following the revision of IAS 23 mean due to change in accounting standard, and in accordance with the revised requirement of that standard, it now capitalize this interest. Is that recognition, presentation, or measurement basis? Policy change, either due to recognition, presentation, or measurement basis. Recognition. Number two, an entity has previously depreciated vehicles using the reducing balance method at 40%. It now uses straight line method. So this is estimate change. Number three, an entity has previously shown certain overheads with cost of sales. It now shows those overheads with administrative expenses. This is presentation change. Number four, an entity has previously measured inventory at weighted average cost. It measures inventory using the FIFO. So this is measurement. Now let's talk about prior period errors. Suppose from year 1, 2, 3, 4, we are currently in year 4. We were preparing financial statements from last 4 years, but here we realized there was an error in the financial statement of year 2. And due to that error, this means year 2 financial statements closing figures were inaccurate. This means year 3 opening figures were inaccurate. This means that error prevail here as well as here. So now we need to correct that error. How? By correcting the error, what was the effect on this financial statement? What was the effect on this financial statements? That we need to adjust in current year financial statements with opening retained earning, and we need to provide a disclosure. Prior period errors are omission from and misstatements in the financial statements for one or more prior periods arising from a failure to use information that was available when the financial statements for those periods were authorized for issue. Mean here, that was not identified. Here, due to some information, that error has been identified. Could reasonably be expected to have been taken into account in preparing those financial statements. Such errors include mathematical mistake in applying accounting policies, or oversight and fraud. Could be fraudulent by the accountant. Current period errors that are discovered in that period should be corrected before the financial statements are authorized for issue. That should be corrected in current year financial statements. But if there are any prior period errors, that should be corrected in prior year financial statements as well. How? Either to produce those financial statements again, or adjust those error in current year financial statements by adjusting to the opening retained earning and providing a disclosure.
So, like we have an example, if the error was in year 2. So we ignore year 3, we only show the corrected balance of year 2.
We will check what was the effect of that error in year 2. What was the effect of that error in year 3? Could be different effect, could be different amounts. And then for those effect, we need to adjust the retained earning. For both years effect.
So we have to
We need to provide a disclosure in the current year financial statements. Mean these previous figure has been adjusted due to this issue by this amount.
So we have to show for the middle years of like year 3.
Yeah, obviously. If the error prevails in year 3 as well. Exactly. What could be the effect on year 3 financial statements? What was the effect on year 2 financial statements? We need to show both. Okay. Correction of prior period errors. Prior period errors are dealt with by restating the opening balance of assets, liabilities, and equity as if the error had never occurred. Mean if the error having effect on asset, error having effect on liabilities, that opening balance should also be restated. If the error having effect only relating to income or expense, then only the opening retained earnings should be restated. And presenting the necessary adjustments to the opening balance of retained earnings in the statement of changes in equity. Mean where retained earnings should be adjusted, statement of changes in equity. Restating the comparative figures presented as if the error had never occurred. Mean previous year figure that are coming along with current year figure in the financial statement, that should also be changed. And disclosing within the accounts, mean we need to provide a disclosure in the financial statements of the financial position at the beginning of the current period. So on. Let's discuss this question. During 20X1, a company discovered that certain item had been included in inventory at 31st December 20X0 at a value of 2.5 million, but they had in fact been sold before the year end. In 20X0, currently we are in 20x1. Mean in previous year, closing inventory 2.5 million was included. But those items were sold out. Mean closing inventory was overstated. Closing inventory was overstated in previous year. This means previous closing inventory was overstated. Current opening inventory was also overstated. Is that the original figures reported for the year ended 31st December 20x0 and the figure for current year 20x1 are given below. Sales, cost of sales, gross profit, tax, net profit. The retained earning at 1st January 20x0 were 11.2 million. Previous year opening retained earning were 11.2 million. The cost of goods sold in 20x1 include 2.5 million error in opening inventory. Obviously, they have explained, even if they don't write down this sentence, we should be aware that if previous closing is overstated, current opening is also overstated. But they have cleared you. In current year, opening inventory is also overstated by 2.5 million. Show the 20x1 statement of profit or loss with comparative figures and the retained earnings for each year. Disclosure of other comprehensive income is not required. Assume that the adjustment will have no effect on the tax charge, mean tax figure will remain same. Mean you need to prepare the corrected profit and loss account. And you need to provide the corrected retained earning, mean adjustment in retained earning. So see. Here we are having 20x1 corrected figure. Here we are having 20x0 corrected figure. Sale will remain same. 5 to 100 and 48 300. We are going to change that error. We are going to, by changing the errors, we are going to prepare corrected financial statement figures.
Error in sales also.
No, in closing stock only.
But they had been sold, so it was recorded in sales.
Sales were okay. This means in this figure, how closing stock reflected, how cost of sale we measure, opening inventory plus purchases minus closing stock. This means this figure, closing inventory is overstated by 2.5 million. Whether we need to add 2.5 million in this or we need to deduct 2.5 million. At suppose 100 minus 8 is equal to 92. But afterward we realize no, instead of 8, that figure was 6. So how we can correct? By adding 2 here, we will arrive at correct figure. So in this figure, we need to add how much? If this is 3,200, so 2.5 million will be 2,500. 2,500. So what is that? 32,700. This means in this figure, whether we need to add or subtract 2.5 million, mean opening inventory is overstated. So we need to subtract 2,500. So what will be that? 31,000. What is GP here? What is GP here?
X0 56.
15,600 and for 20x1? 21? 100. Tax will remain same. 4,300, 4,600. What are the corrected profit?
300.
Are you with me till that point? How we have calculated the corrected profit and loss account. Now we are moving towards adjusted retained earning. Adjusted retained earning. In 20x1, what was the retained earning? 20x0. 11.2. We can say 11,200. In that, what should have been adjusted? This. And if we add this profit 11,300, what should be the closing figure? 22,500. That should be the opening figure here. Correct it, correct it. In that, what profit we need to add? 16,500. So what is the closing retained earning for 20x1? 38, 39, 39,000. So as per correct rate, we have adjusted the retained earning. And this should be the correct retained earning. Mean from previous year, what retained earning was coming? 11,200 with wrong profit of 13,800. What's that figure? 25,000. What's the adjustment in that? 2,500. What's that? 22,500. That is the same. Mean we need to adjust opening retained earning in current year. This was coming, but we need to adjust with 22,500 through this adjustment of closing inventory figure that was included in the profit. Can you understand this? IAS 8 completed. Now we are moving towards another accounting standard, IFRS 13. Fair value measurement. Only theoretical based standard. There's no calculation involved in this standard. Fair value measurement. All right. Thank you. So sometime while preparing financial statements, we need to measure fair value. How we can measure fair value? Where this standard will apply, where this standard will not apply, let's discuss. The objective of IFRS 13 is to provide a single source of guidance for fair value measurement, where it is required by our reporting standard rather than being spread throughout several reporting standards. IFRS 13 will improve comparability between many standards that require fair value measurement or fair value disclosure. What is fair value? Fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It is a price of the asset that we can receive by selling the asset or by adjusting the liability. Fair value may be required to be measured on a recurring basis or non-recurring basis. What is recurring basis? Continuous basis. Mean where we gonna use that asset in future as well. Non-recurring basis, we are just selling that asset. We will not continue this asset in future. Non-recurring mean we need to measure fair value just once. Asset sold, we don't need to calculate fair value for that asset again. Recurring basis mean if you have adopted fair value basis, then every year you need to measure the fair value. Recurring mean continuous basis. Non-recurring mean one time while selling the asset. We will study consolidation later on in our syllabus. In consolidation, when we acquire any subsidiary, we need to record, we need to consolidate subsidiary asset on fair value basis. And in that, we measure fair value on a non-recurring basis. But the asset we are normally using in our business and we have adopted a fair value model, and the assets will be continue onward. So that will be recurring basis. We'll study recurring, non-recurring next page. IFRS 13 establish a hierarchy that categorizes the input to valuation techniques used to measure fair values as follows. Mean there are three types of methods to measure fair value. Mean fair value, we get input from somewhere, either from market prices, either from information. Level one. What is level one to measure fair value? Input comprise quoted prices, market quoted prices, observable in active market where this kind of assets are normally buy sell. For identical asset and liabilities at the measurement date, this is regarded as providing the most reliable evidence of fair value and is likely to be used without adjustment. So what is level one method of measuring fair value? We use quoted prices from active market. That is more reliable evidence of fair value. And we use this fair value without any adjustment. Three words you need to remember: quoted market prices, more reliable evidence values, and use without adjustment. Is that what is the level two method? Inputs are observable inputs other than those included within level one above, which are observable directly or indirectly. This may include quoted prices. This may include level one, comprise quoted prices. Level two may include quoted prices for similar, not identical assets. In level one, similar asset, identical asset. That's why that is more reliable. But level two measurement is we are using values that could be quoted prices for similar but not identical assets from active market. For identical or similar assets in active market, typically they are likely to require some degree of adjustment to arrive at measuring fair value. In level one method, quoted prices more reliable, no adjustment to the prices is required. Level two, quoted prices for similar but not identical asset. And we need to make adjustment to that price to arrive at fair value. Because the asset are not identical. The asset is a little bit different. If you are having identical asset in the market, then you will use quoted prices, and that is level one, more reliable measure. What is the level three? The inputs are unobservable inputs for an asset or liability based upon the best information available. I mean, not quoted prices based on the information from the market, including information that may be reasonably available relating to market participants. And that is remotely reliable. Remotely mean very little reliable. Because you are calculating amount fair value based on information from the market, not the quoted prices. Can you understand how fair value can be measured using level 1, level 2, level 3 methods? Let's move. What does it mean by recurring basis and non-recurring basis? Recurring basis, fair value on a recurring basis arises when a reporting standard required fair value to be measured on an ongoing basis, mean every year. An example of this is IAS 40 investment property. If you have adopted fair value model, every year you need to check the fair value of the investment property and record investment property accordingly. And this is excluded from depreciation if you are recording on fair value basis. What is a non-recurring basis? Fair value of a non-recurring basis arises when our reporting standard require fair value to be measured at a fair value only in certain specified circumstances. This would apply, for example, with the application of IFRS 3 business combination mean consolidation. When you're acquiring any subsidiary, you need to consolidate subsidiary results with your results, parent company results, but based on fair value only when you are acquiring. Where items are measured at fair value at the date of acquisition only. In future, we will not measure fair value. In future, whatever the value we have incorporated once, that will be used as a cost. Measurement, when measuring fair value, an entity shall take into account the characteristics of the asset or liability. Such characteristics include, for example, the following: condition and location of the asset, restriction, if any, on the sale or use of the asset. An entity shall measure the fair value of an asset or liability using the assumption that market participant would use when pricing the asset or liability, assuming that market participants act in their economic best interest. They are talking about fair value of liability, that we will discuss in financial instrument chapter. Next chapter. Currently, we are just discussing about fair value of asset. Some account balances are excluded from IFRS 3 fair value measurement. IFRS 13 does not apply to IFRS 16 leases. That we will cover in next chapter. Or it's a situation where different measurements are required, such as net realizable value, like on inventory, or value in use, IAS 36, while calculating my impairment, which may be required by some reporting standard. Meanwhile, measuring net realizable value, this fair value IFRS 13 will not apply. While calculating impairment, especially in value in use, this standard will not apply. While calculating leases amount, this standard will not apply. We know level 1, level 2, level 3 methods are used. Disclosure: an entity shall disclose information that help user of the financial statements assess both the following. How fair value is measured, you need to disclose as well. This standard also completed. Let's discuss one more standard that we have already studied in financial accounting. IAS 2 inventories. IAS 2 inventories. IAS2 inventory says inventories should be valued at lower of cost and net realizable value. Cost mean purchase cost and some expenses. What could be those? We'll discuss. As well as if you have manufactured the inventory, so raw material, labor, overhead should also be part of cost. What is meant by net realizable value? Selling price less cost to sell. So we need to calculate cost, we need to calculate net realizable value, and what figure is lower, we should record closing inventory on that figure. Because we need to measure closing inventory figure. That will be opening for next automatically. But at year end, we need to calculate value of closing inventory. Cost is the cost of bringing item of inventory to their present location and condition, including cost of purchase and cost of conversion. Cost of conversion mean labor plus overheads that you have studied in management account. In all the costs incurred to present the inventory in present condition location are part of cost. Cost of purchase include purchase price, including import duties, transportation, and handling cost. And this handling also called storage cost of material. Storage cost of material. This transportation is also called carriage inward. Any other directly attributable cost, less trade discount, rebates, and subsidies. If on buying material, you received any discount, you received any discount in a tax, you received any government subsidy, so that should be deducted from the cost. Cost of conversion comprises costs which are specifically attributable to unit of production, for example, direct labor, direct expenses, and subcontracted work. Production overheads, which must be based on the normal level of activity. Normal level of activity, what does that mean? We will cover our question later.
But other attributable costs, you record that after the discount.
Mean in buying material,
Yes.
if the purchase price is 100, but supplier has provided you 5 discount, so you need to record the cost 95 rather than 100.
Fine.
Other overheads, if any, attributable in the particular circumstances of the business to bringing the product or service to its present location and condition, like any machinery used, its depreciation should also be part of production cost. The following costs should be excluded and charged as an expense the period in which they incur, mean these should not be part of cost. What are those? Abnormal wastages. Storage cost. This is relating to finished goods, not the material. This is relating to finished goods, not the material. Material storage cost will be part of the cost. But the finished goods storage cost should not be part of inventory cost. Because that is business operating expenditure. Mean before selling, you are holding inventory, so that is your admin expense. But if you are storing material before putting into production, that should be part of inventory cost. Admin overheads which do not contribute to bringing inventories to their present location and condition. Mean factory, land and building of the business, motor vehicles, If they are not part of production, their depreciation should be charged as operating expense rather than production cost. And selling cost should not be part of inventory cost. What is net realizable value is the estimated selling price, obviously actual, while selling the inventory we can measure. If we are not selling now, so we can only estimate the selling price. In the ordinary course of business, less the estimated cost of completion and estimated cost necessary to make the sale, mean selling price and cost to sale, that will be estimated to calculate NRV. Because actual, we can calculate while making sale. So before making sale, we can just estimate. Inventory valuation method, IAS2 deal with the three methods of arriving at cost: actual unit cost, first in first out method, weighted average method, and these methods we have learned in financial accounting. Examiner will not ask here to calculate inventory using these methods.
It's not coming for this.
Where item of inventory are not ordinarily interchangeable, for example, used car, IAS2 require the actual unit cost valuation method to be used. Such items should be shown at their actual individual cost. Mean unit cost method is used for usable inventory. Where items are ordinarily interchangeable, for example, tins of beans, the entity must choose between two cost formulas, either FIFO, either AVCO. There was one method, LIFO, but that is eliminated now. That was bad method. The item coming later should be out first. This means the item came first will become obsolete, out of date. The same method of arriving at cost should be used for all inventories having similar nature and used to the entity for inventories with a different nature of use. Different cost method may be justified. Means similar nature inventory items should be measured using the same method, either FIFO, either AVCO. If you are having a 5 inventory type of similar nature, and you are measuring 3 on FIFO, 2 on AVCO, that will not be acceptable. Different nature inventory can be measured using different methods. Disclosures. The main disclosure requirement of IAS2 accounting policy adopted, including the cost formula used, total carrying amount classified appropriately, amount of inventories carried at NRV, mean what is the cost, what is the NRV. Classification mean in a total figure, what is the raw material, what is work in progress, what is the finished goods, you need to provide disclosure. Amount of inventory recognized as an expense during the period, you need to provide disclosure. Detail of any circumstances that have led to write down of inventories to their NRV if you are recording inventory, especially on NRV. Because for normal inventory, cost is always lower because in NRV profit is also included. But if your NRV is lower than cost, might be your inventory become obsolete, out of fashion, damaged. So you need to provide a disclosure in the financial statement. Why you are recording inventory on NRV, mean why NRV is lower than cost. Test your this illustration. Part A and B. Can you measure the closing inventory figure? Please try to calculate closing inventory figure. Please remember, inventory should be measured load of cost and NRV. NRV means selling price less cost to sell. Selling price mean at what price we can sell the inventory in the market rather than buy the inventory in the market. Selling price doesn't mean fair value. Selling price doesn't mean fair value. Part A. Material costing 12,000 bought for processing and assembly for a profitable special order. So this is the cost. Since buying these items, the cost price has fallen to 10,000. Now we can buy this amount inventory in 10,000. What is the cost? That you paid 12,000. Now you can buy at 10,000. This is fair value, market value now. This is not net realizable value, means selling price. So there is no NRV in this question. We need to compare cost with NRV, not with the fair value. So this is useless. So inventory should be recorded at 12,000. Because we are having one figure only. Can you understand this? This 10,000 is not NRV. NRV means selling price at what amount you can sell your inventory rather than you can buy similar inventory. Part B. Equipment constructed for a customer for an agreed price of 18,000. This is a selling price. 18,000. That you agreed with the customer. This has recently been completed at a cost of 1,600, while cost is 16,800. It has now been discovered that in order to meet certain regulations, conversion with an extra cost of 4,200 will be required. The customer has accepted partial responsibility and agreed to meet half the extra cost. Customer is saying the half cost I will meet. What is the half? 2,100. It has now been discovered that in order to meet certain regulations, inventory has been completed now. Conversion with an extra cost of 4,200 will be required. The customer has accepted partial responsibility and agreed to meet half the extra cost. Mean 2,100 customer will pay. What is the selling price? What is the cost now? 2,900. If you deduct 2,100 from here, how much is that? This is not extra cost.
15 like something.
50?
Like
100.
These are selling expenses. To sell this inventory, to transfer this inventory to customer, you need to bear 4,200. But from these 4,200, you will pay 2,100. Selling price less cost to sell. This is your NRV. That is lower than your even initial cost.
The cost won't increase.
That obviously that will also increase. But this 4,200 is not a cost. These are selling expenses. Cost to sell is not production cost. Cost will remain same. This is your selling price that you agreed with the customer. But to transfer this inventory to the customer, you need to bear 4,200. But you will not pay 4,200. You will pay half customer will pay. Half customer will afford, half customer will bear. So your cost to sell are 2,100. Half. These are cost to sell rather than production cost. Cost means production cost. What should be the value of inventory? Start. Done? Okay. Let's move towards the last standard of this chapter. IAS 41, agricultural asset. Agricultural asset. Agricultural asset. We record property, plant, and equipment. Cost less accumulated depreciation. Intangibles. Cost less amortization. IAS 16, IAS 38. IAS 41 is about agriculture asset. Agriculture asset, how we measure fair value less point of sale cost. Fair value less point of sale cost. Fair value mean market price. What does mean by point of sale cost? What are agriculture asset? Any crop, fruit. We are having cows, sheep, goat, camels. These are also part of agriculture asset. Mean living animals and plants and produce of plant. Agriculture asset mean living animal, living plants and produce of 1 and 2. What is produce of animals? Milk, egg. Agriculture asset mean living animals, living plants. Living animals mean cow, sheep, goat, hen, ducks, camels, horses. Living plants, trees. And their produce. What is produce of living animals? Milk, eggs. Produce of plants, fruits, wheat, rice, vegetables. How we should record agriculture asset? Fair value less point of sale cost. What does mean by point of sale cost? Point of sale cost mean commission paid to broker plus levies. Levies mean all tax. These agriculture asset we cannot sell in the market by ourselves. We can sell these things in their market only. Fruit we can sell in fruit market. Vegetables we can sell in fruit and vegetable market. Animals we can sell in animal market only. And we cannot sell directly. There are some brokers available in those markets. Through them you will sell. Or either you need to register your business as a broker. And if you are selling through any broker, you need to pay commission to that broker, agent who is helping to sell these products. Plus levies. Levies mean toll tax. Toll tax means salik. Road tax. In some countries, if you want to move your agriculture produce, your animals from one place to another, on the way you need to pay some toll tax. Toll tax means salik in UAE, because you are using this road and you are crossing this to that, you need to pay the tax.
That doesn't come under overheads.
No, that will be part of point of sale cost. These tax are not sales tax. These tax are not income tax. These tax are called levies like salik in UAE. In other country, its name could be different. Toll tax means moving from one place to another. On the way, you need to pay this tax. If you are using any highway, you need to pay this tax. And this thing is not in our book. The commission paid to broker and levies. They have just talked about, even they haven't talked about what is point of sale cost. But in question, business need to pay commission while selling this. So what does that mean? That is point of sale cost. So how agriculture assets should be measured? Fair value less point of sale cost. What are agriculture assets? Living animals, living plants, and their produce. Okay, let's discuss. We should take a break first. Take a break. With fresh mind, we will discuss this standard and we will move towards further questions. So take a break. IAS 41 agriculture asset. How we should measure? Fair value less point of sale cost. Point of sale cost mean commission paid to broker while selling the asset plus any levies mean tool tax. And agriculture asset mean living animals, living plants, and their produce. Okay, let's read. IAS 41 agriculture relate to biological asset. Biological asset mean living animals and living plants. Government grants in some time to produce something, especially in agriculture sector, to promote agriculture sector, government provides some grants as well. That grant we should record as income. And agriculture produce at the point of harvest. Fruits, vegetables, rice, wheat at the point of harvest. Products which are the result of processing after harvest will be dealt with under IAS 2 inventory. Cows, goat, sheep are agriculture asset. They produce, hen is agriculture asset. They produce eggs, milk is agriculture asset. But if through milk you have made a cheese, that is not agriculture asset, that is inventory. You're having different animals that are agriculture asset. But you are selling the meat of those animals, so that meat will be inventory. Is that fine? Are other applicable standards? The table below gives example of each biological asset, agriculture produce, and products resulting from processing after harvest. Mean cheese from milk, that is outside the scope of IAS 41. What are biological assets? Sheep, trees, dairy cattle, pigs, cotton plants, sugarcane, tobacco plants, tea bushes, grapevine, fruit trees, oil palms, rubber trees. These are all living plants, animals. They produce wool, felt trees, milk, carcass, harvested cotton, etc. Fruits, vegetables produce also agriculture asset. But these things, yarn, through wool, carpet, lumber, cheese, sausages, meat, tea, wine, these are inventories. These will not be covered on IAS 41 agriculture asset. Biological assets. What are biological assets? Biological assets in our living animals are plants. A biological asset should be recognized if it is probable that economic benefit will flow to the entity. The cost or fair value of the asset can be reliably measured, and the entity control the asset. They should be recorded as agriculture asset. Recognition and measurement initially measure fair value less any estimated point of sale cost. If there is no fair value, then the cost model should be used. Like if for any animals, you cannot measure fair value, then in whatever amount you bought that cow, you will use that amount. Subsequent measurement, revalue to fair value less point of sale cost. At year end, taking any gain or loss to the statement of profit or loss. Any gain or loss in measurement, like previous fair value less point of sale cost was 90,000. Current fair value less point of sale cost is 95,000. So that 5,000 gain, where it should be recorded? Profit and loss account. Suppose current fair value less point of sale cost is 85. This means 5,000 loss. Where it should be recorded? Profit and loss account. Bearer plants. What are these? Bearer plants will not be recorded as IAS 41. They will be recorded as IAS 16 property, plant and equipment. Biological asset. Biological asset mean living plants. The plants that we can sell as a plant are called biological asset. Bearer plants are those plants. Through these plants, we take either fruits or vegetables and we sell those fruits and vegetables, not the plant. So that fruit or vegetable produced through this plant is called agriculture asset. But the plant itself is not agriculture asset, that will be treated as property, plant and equipment. What is the difference between bearer plant and biological asset? Bearer plant are those plants through which we produce fruits and vegetable and sell that fruit or vegetable. So that fruit and vegetable fair value will be agriculture asset. The value of that plant will not be agriculture asset. Those plants that we gonna use in more years in future, just to take its produce, will be called bearer plant. And those plants that we might sell within a year, and we're gonna sell the plant rather than its produce. So that will be agriculture asset, mean biological asset. Can you understand this distinction between biological asset and bearer plant? Bearer plants are accounted for under IAS 16, property, plant and equipment, rather than IAS 41, agriculture. A bearer plant is a living plant that is used in the production or supply of agriculture produce. Mean it produces fruits or vegetables. Is expected to bear fruit for more than one period, mean we're gonna use this plant for more than 1 year. We are not having intention to sell this plant. We are using this plant to produce fruits. Mango plant, orange plant. Has a remote likelihood of being sold, mean there are less chances we gonna sell this plant. Remote mean less than 5% chances we're gonna sell this plant. As agriculture produce, except for incidental scrap sales, and when we will sell, might be there will be some scrap value. But we're gonna use this plant for many years to get its produce to generate income. So bearer plant will not be part of IAS 41 agriculture asset, mean biological asset. Therefore, items such as vines, tea bushes and fruits trees may be classed as bearer plant and treated as property, plant and equipment, rather than being accounted for under IAS 41 agriculture asset. Agriculture produce: wheat, rice, eggs, milk. At the date of harvest, the produce should be recognized and measured at a fair value less estimated cost to sell. Estimated cost to sell mean commission paid to broker, point of sale cost. Gain and loss on initial recognition are included in profit and loss. After produce has been harvested, IAS 41 ceases to apply. And after that, IAS 2 inventory will apply. This you need to read by yourself. just to clear idea, mean they have provided the same as explanation here. Now, if we are receiving any government grant in case of agriculture asset, so IAS 41 applies to government grant related to biological asset. And grant could be of two types, unconditional government grant and conditional grant. Unconditional mean government have provided you grant to promote agriculture. There is no condition attached. You need to record it as income immediately. But if there is, suppose, any condition attached, and condition is that you need to invest this grant in producing plants. And if you have incurred the expense to produce plant, then you should record this as a income. But if you haven't produced anything, but you received amount from the government, you should not record it as a income. Unconditional mean government didn't say anything. In that case, record as income. But if there is any condition attached to the grant, you need to meet that condition, then you should record as income. Otherwise, you should record it as liability. Because if you will not meet the condition, ultimately you need to pay back to the government. So unconditional government grant received in respect of biological asset measured at a fair value are reported as income when the grant becomes receivable. If such a grant is conditional, including where the grant requires an entity not to engage in certain agriculture activities, the entity recognizes it as income only when the condition have been met. If the condition is not met yet, you should not record this as income. You should record this as deferred income, mean liability. In future income, where you will record deferred income in liability. Because if you will not meet the condition, government can call back. If you have fulfilled the condition attached to the grant, okay, that's fine. Now grant is your, record it as income.
Contingent asset.
No. Contingent asset, what does contingent asset mean? Probability of future economic inflow.
Of the grant.
You have received the amount, but you haven't fulfilled the condition. You cannot record it as income. Contingent liability is a obligation. That is something else. That is relating to any event. This will be recorded as deferred income. Mean in future, if you will meet condition, you will record as income. If you will not fulfill the condition, government will call back. You need to pay back. Got it? Asset outside the scope of IAS 41. IAS 41 does not apply to intangible assets protection quota or to the land related to agriculture activities. The land will not be recorded as agriculture asset. That will be treated as property, plant and equipment under IAS 16. So you are having plants on a land, but that land will be treated as IAS 16 property, plant and equipment. The animals, the plants, the trees, their produce will be treated as agricultural assets. Test your understanding one. Good luck, everybody. Any change in fair value less point of sale cost should be charged to profit and loss account. Recalculate the figure. That should be charged to profit and loss account based on the asset valuation change. Third of five 4-year-old pigs were held on 1st January 20x3. How many pigs are there? 5. On 1st July 20x3, a 4.5-year-old pig was purchased for 2012. 5 you were having at start of the year. During year, after 6 months, you bought another pig for $212. Now you are having 6 pig. What's their life? All having life of 4.5 years now. 6 months they pass, obviously, they become 6 months more old. The fair value less estimated point of sale cost were 4-year-old pig at 1st January 20x3 was 200. $4.5-year-old pig at 1st July 20x3 2012 that we purchased. While 5-year-old pig at 31st December 20x3, the value is fair value is 230. What should be the amount that should be charged to profit and loss account for the year ended 31st December 20x3? In start of the year, in end of previous year, you were having 5 pigs. And their value was how much? 200. 4-year-old. What's that? 1,000. What is this? Fair value less point of sale cost. Now at 31st December 20x3, you are having 6 pigs. And they all are 5-year-old now. The one you bought during the year, his life was 4.5. After passing 6 months, it's 5-year-old. And the 5 at the start of year having life for 4 years. Now at end of year, they are having 5-year life. So what's the value of 5-year? 230.
1380.
1380. Is there any gain or loss of how much? 3 years.
In the initial file 200, we didn't record the purchase amount. No?
That is automatically included in this. You purchased, okay, what is his life now? What is his value now? We need to measure fair value where? At year end.
The gain for that pig will be less because
We should recognize asset using cost less accumulated depreciation when at year end. In the similar manner, agriculture asset should be recognized in balance sheet when at year end. How? Fair value less point of sale cost. So in previous year financial statements balance sheet, mean you can say 20x2, the value was recorded this. Now at 20x3 year end, we will record value this. Fair value less point of sale cost, not cost purchase cost. So we bought in 2012. But what is his value now? Fair value now at 31st December 20x3. His fair value is 2030. Even the 5 we were having End of previous year, what is their value? 230.
But on first July. when
We bought,
we
we bought. That is included in the asset,
So what value will we record for the purchase?
but we need to record at the year-end value. While preparing financial statements, we need to record the asset value. Like suppose this is the ledger. At start of the year, we were having 1,000 value. We bought one more at 212.
Yeah.
Closing figure might be we are having a 1 to 12. But we should not record this in financial statement. We should record what? Fair value less point of sale cost. And we compare fair value as compared to previous year figure and current year figure rather than what is going on during the year. Can you understand this? So fair value at 31st December is this. What is the change in fair value as compared to previous year? That is 380. What happened during the year, that's another time story. Obviously, that happened is already included here.
My question is, so the difference between 230 and 212, the 18, we don't record that as gain.
Difference between 230 and 212? No. That is automatically adjusted in there. Because we need to compare previous fair value and current fair value of biological asset. And any addition, any subtraction, we have counted here. Is that? Test your understanding too, please. Good luck, everybody. Show extract from the financial statements for 20x1 for these activities, assuming that no cows were purchased or sold during the year. Mean what should be the figure for balance sheet? What should be the figure for profit and loss? You need to show that. Here, McDonald is the name of the person. McDonald is not a fast food brand.
Okay, so
McDonald, in this question, McDonald is the name of a person. You have seen some players having name McDonald. McDonald's operates a dairy farm at 1st January 20x1. He owns 100 cows worth 1,000 each on the local market. So their value was 100,000 at start of the year. At 31st December 20x1, he owns 105 cows worth 1100. So 100 into 1000 is 1000. Now 105 into 1100, how much is that?
1155.
1155. 115500. During 20x1, he sold 40,000 gallons of milk at an average price of 5 per gallon. When cows are sold at the local market, the auctioneer charges a commission of 4%. This means 21st January 20x1 mean 31st December of 20x0. This means 20x0, the value is what? 100,000 less 4% commission mean point of sale cost. What was the asset value in balance sheet at that time? Less 4%. If we want to deduct 4% from this, we can multiply it by 96%. What's the value?
86,000.
96,000. Now at 20x1 year end, the value is 115,550 into 96%. What's the value now?
1088.
110880. At this value, asset should be recorded in statement of financial position. What is the difference? Is there any gain or loss? How much is that? 40, 14,880. This means in statement of profit and loss account, we should record revenue by selling the milk. How much milk we sold? 40,000 into 5 per gallon. How much is that? 200,000. Fair value gain of how much? 14,880. While in a statement of financial position, we will record what? Biological asset. Our agriculture asset, how much? How much? 110880. When cows are sold at the local market, the auctioneer, mean agent, broker, while selling cow, mean cow doesn't have a exact value because some cows are large, bigger in size, some cows are smaller in size, so they can be sold through auction. Mean people will offer their bid. People will offer their bid. The highest bidder will be able to buy the asset.
But it's mentioned that has been no cows are purchased or sold.
Yeah, but no purchase sold. This means the quantity of cow will remain same. But we should record fair value less point of sale cost. Depreciation here. What is mean by depreciation here? Point of sale cost. We cannot sell at this value. We need to pay some commission. So what is net realizable value, you can say? In balance sheet, we need to record fair value less point of sale cost. This is fair value. What is the point of sale cost? Commission paid to broker while selling, and any levies. Levies is not in your syllabus. Is that? Let's move forward. Test your understanding 3. Number 1, please give me 2 options. Which two of the following situation would not require a prior year adjustment per IAS 8? Accounting policy change in accounting estimate and error. Obviously, you need to find what is accounting estimate change that doesn't require prior adjustment. Because for a policy change, prior adjustment required. Prior is the error, prior adjustment is required. Estimate change, no prior adjustment required. This means you need to identify what are the estimate change. A. In last year, financial statements inventories were understated by material amount due to a system error. In last year, this means prior adjustment required. The question we covered, where we adjusted the closing inventory in last year and current year and adjusted in retained earnings. So a company has changed its allowance for irrecoverable receivable from 10% of outstanding debt to everything over 120 days old. And this allowance for receivable is estimated figure. So this doesn't require any prior adjustment because this is estimate change. A new accounting standard has been issued that require a company to change its accounting policy. Change in accounting policy will require prior adjustment. A company has chosen to value inventory using FIFO rather than AVCO. This is also policy change, require prior adjustment. A company has decided to move from changing depreciation on straight line to reducing balance. This is also estimate change, doesn't require prior adjustment. Number 2. In accordance with IAS 8 accounting policy, changing in estimate and error, how is a change in accounting estimate accounted for? By changing the current year figure, but not the previous year figure, yes. By changing the current year figure and the previous year, this is relating to policy change. No alteration of any figure, but disclosure in the notes, no. Neither alteration of any figure or disclosure, no. Number 3, please. Yeah. Which one is not true? A, level 1 inputs are likely to be used without adjustments. Yes. Quoted prices, similar identical asset, more reliable evidence, no adjustment. Level 1 inputs comprise quoted prices in active market for identical assets and liabilities at the reporting date. Yes. Level 2 inputs may include quoted prices. Yes. For similar but not identical assets. Yes. Then what is left? D. Level 3 inputs are based on the best information available to market participants and are therefore regarded as providing the most reliable, no, remotely reliable. Number 4. Number 4 is which of the following would not normally be included as part of cost of inventory in a manufacturing business? Cost of transporting finished goods to customer. Yes, this should not be part of cost. Storage cost of raw materials stored at the premises of a third party. Storage cost of raw materials stored at the premises of third party. Discount allowed for prompt payment by customer. Relating to customer, not relating to part of cost. Discount received for bulk purchases. This we need to deduct from the cost. What is the option then? If we look at part A, 2 and 4 only. 1, 2 and 3. 2, storage cost for raw material. Storage cost for finished goods should not be part of cost. But for raw materials stored at the premises of a third party.
Is it rent expense instead of cost?
Because this should be included.
The third one.
Is there any option 1 and 3 only? No. Because 1, 3, these are clearly relating to after production, mean relating to sales. These should not be part of cost. If there is no other option, we can assume this is also, so we can tick C. But storage cost of raw material should be part of cost. For finished goods should not be part of cost.
It's really cost. It is cost.
3, discount allowed for prompt payment by customer.
Yes.
Mean we have allowed a discount to customer. If you will pay us early, we will provide you discount. That is not relating to cost. That's relating to sale. You know, if we receive discount from supplier, that we should deduct. So 1, 3 are clear. But there is no option for 1 and 3 only. So as in the book, they stated storage cost should not be part of. But as per logic, storage cost of finished goods should not be part of cost, but raw material should be part of cost. So we assume they are not distinguishing between that. Number 4 or number 5. You need to calculate the value of closing inventory. Good luck, everybody. I assume you people have studied management accounting as well. Financial accounting as well. This is relating to management accounting. Closing inventory figure. The following costs relate to a unit of goods. Cost of raw material per unit is 1. Direct labor is 0.5. During the year, 60,000 of production overhead was incurred. Total production overhead 60,000. But we need per unit because we are having this data per unit. 8,000 units were produced during the year, which is lower than the normal level of activity, 10,000 units. And we learned we should use normal activity while calculating production overheads for inventory cost. This means overhead should be 60,000 divided by 10,000 normal activity, and that is 6.0. This was as a result of a fault with some machinery, which resulted in 2,000 units having to be scrapped. That's why they actually produce 8,000 units, but their normal activity level is to produce 10,000. And we should allocate production overheads as per normal activity. At the year end, 700 units are in closing inventory. What is the cost per unit? 7.5. How many units?
700.
So what is the value?
5.
5250. 5250. Simple. Number 6. Good luck, everybody. Law of cost and NRV. Give me the figure. Sure. Figure.
So, 214,300.
214,300.
210,000.
210,000. Both are wrong. I need different answer. There is no option of 210 or 213,400. There are no options. So Posh PLC has the following unit in inventory at the end of 20x9. Raw material 5,000 unit and cost per unit is 25. Work in progress 2,000 unit and cost per unit is 30. Finished goods 1,000 units, cost per unit is 35.
207.
Yes. Finished items usually sell for 50 per unit. Selling price of finished goods is 50 per unit. We need to compare cost and NRV. However, water damage caused by improper storage of inventory will mean that there was heavy rain, like in UAE, and due to that, in storage, some unit destroyed. 300 units of finished goods will be sold at 60% of normal selling price, less cost to sell of 5 per item. Out of these 1,000, 300 become damage. They can be sell at 60% of normal price. What is normal price? 50. What is 60% of 50? 30. Less 5 cost to sell mean 25. In 300 units, we can sell at 25 per unit, though their cost is 35. A further 550 per unit is still to be incurred to finish off the item of work in progress. This is relating to work in progress, not relating to material, not relating to finished goods. If we look at, so raw material, the cost is 5,000 units, per unit cost is 25. What's the value? 125,000. So this is the cost. And are we having any NRV? No. There is no NRV. For work in progress, what is the cost? 2,000 units at 30, we are having 60,000. What is their NRV?
2,000 into 5.5.
If suppose we take their selling price 50, we take their cost to sell 550. Suppose we are having a 44.5. Even NRV will be higher than this. This means we will take it on cost. Because he's saying a further 550 per unit is still to be incurred to finish off the item of work in progress. Mean they require further cost if you want to sell it. But we can ignore, like we cannot calculate NRV. Now we talk about finished goods. And in finished goods, we are having 700 separate units whose cost is 35. What's that? 24,500. And whose NRV for 700 is 35,000. So we will ignore it. Lower of cost NRV. And for remaining 300 units, their cost is according to 35. How much is that? 10,500. And their NRV is what? 300 multiplied by 25. What's that?
7,500.
7,500. This means we should take this figure, we should ignore this.
300 into 25.
300 into 25, 7,500.
No, but why did it 300 to 55?
Cost, to calculate cost, because we need to compare cost and NRV. We are comparing cost and NRV. So raw material, we will take the figure what, how much, 125,000. For work in progress, we will take the figure 60,000. For finished good, this 700 unit, we will take the figure 24,500. And for this 300 unit, we will take the figure 7,500 altogether 217,000. Mister, how you calculated 2014 300, 2013 400? You,
Okay.
he calculated accurately.
Yeah, I got it. What I did was, instead of 50 times 60%,
Mhm.
35 times 60%. It's wrong.
Okay, number 7. Good luck, everybody. How we can verify gain loss by comparing fair value less point of sale cost. B. B. Mister B. Ragi, what is?
B.
B. Mr. Hassan, what is the answer? Is not there. Jacobs owned a 1-year-old herd of cattle on 1st January 20x6, recognized in the financial statement at 140,000 at 31st December 20x6. The fair value of a 2-year-old herd of cattle is 170,000. Obviously, now they become 2-year-old. Cost to sell are estimated to be 5,000. At what time? 31st December. So 20x5, we can say their value was 140,000. What is the value at 20x6? Sorry. The asset value now, what is that? Fair value less cost to sell. Point of sale cost. Point of sale cost means cost to sell, commission, levies. What is the gain? Identify which of the following items would be accounted for under the provision of IAS 41. What should be accounted for under IAS 41 and not IAS 41? Sheep.
No.
41.
Sheep, living animals, biological asset. Wine,
Not agriculture.
that is your inventory. Through grapes, you produce the wine. And wool, agriculture produce.
But if you're selling one,
Then it will become, while at the time of selling, it will become inventory. So this chapter completed. Let's have some MCQs from Kaplan Git, because I haven't identified specific MCQs from BPP Git. So we are going to cover some MCQs from Kaplan Git. MCQ number 70. To which of the following item does IAS 41 agriculture apply? Good luck, everybody. Number one, a change in fair value of a herd of animals relating to the unit price of the animals. Yes, apply. Logs held in a wood yard. Logs mean wood boxes. Doesn't apply. Farm land which is used for growing vegetable land is not part of agriculture. The cost of developing a new type of crop seed which is resisted to tropical diseases, that is development cost intangible asset. So option D, 71. Which should be part of cost of inventory? Marketing and selling overheads? No. Variable production overheads? Yes. General management overheads? No, these are admin. Factory management overhead allocated to production? Yes. Cost of delivering raw material to the factory? Yes. Abnormal increase in overhead charges caused by unusually low production level due to the exceptionally hot weather. No, abnormal loss is not. Good luck, everybody, with 72. We have already covered this. You need to give me the figure. For both inventories, 1 and 2, combined figure. Similar question we have covered, only the figures are different. Amount.
500.
500, 8,
800. Mean from this item 1, we will take only the 24,000 because there is no NRV. And from this is the selling price. Half cost to sell we need to incur. So 33,600 minus 4,200. What's that? No, this is sorry, selling price. 36,000 minus 4,200. The half is 4,200. So 24,000
21,
plus 31,
800.
800. So all together how much?
20,
55,
800.
800. Okay. 73. Good luck, everybody. Easy. Answer B. Mister, this should be included.
3.70.
Import duty should be included. Back labor should be included. Subcontractor labor cost. Recoverable sales tax. No. Storage cost.
Is it not? They have specified.
It's not specified. Production overheads per unit. Production overhead per unit, yes. And there was problem with the first batch of item produced, so abnormal wastage should not be included. If we include storage cost, the answer is A. If we do not exclude, the answer is B. In book, they stated storage cost, but if simple storage cost is there, we assume it is relating to finished goods. So we can ignore it.
So in the
Even the answer at the back is B.
so the state just storage cost we don't do.
74. Good luck, everybody. The most difficult question for the day. Not that much difficult. Cost is given 1 million. You need to calculate NRV. And by comparing, you can say the value of closing inventory. So on 30th September 2024, reserves closing inventory was counted and valued at its cost of 1 million. This includes some item of inventory which had cost to 10,000 and had been damaged in a flood on 15 September 20x4. These are not expected to achieve their normal selling price, which is calculated to achieve a gross profit margin of 30%. If inventory cost is given to 10, their gross profit margin 30% given, can you calculate what could be the normal selling price then? Yeah, for this 210. We know sale less cost is equal to gross profit. If this is 30%, this is 100, this means this cost itself is what, 70?
70%.
Mean this is 70% we are having as to 10,000. We want to know 100%.
300,000.
The thing that is itself we need to divide where we want to go, we should multiply.
73.
So 300,000 will be normal selling price of this inventory. You know, 300,000 will be normal selling price of this inventory. Okay. The sale of these goods will be handled by an agent who sell them at 80% of normal selling price. Mean these items can be sold not at 300, they can be sold at 80%, mean 240,000. And charge a commission of 25%. Commission on what amount? The amount of sale. Mean if he charged 25%, what is 25% of these 240? If we deduct that commission, means selling price less cost to sell, we are having an RV of this inventory as 180. What is its cost? 210. This means 1 million we are having cost. If we deduct from this that 210 cost that is damaged, the value of that inventory is what? Lower of cost and RV 180. So 970,000 is the value as per NRV. Is that? Two more MCQs and then we're gonna finish 75. What is accounted for as IS 41 and not? Dairy cattle,
Agriculture,
milk,
agriculture,
cheese.
No.
not agriculture.
Last MCQ 76 and finish. Good luck, everybody. E. D. Mister. Answer. D. D. Magna owned cattle recorded in financial statements at 10,500 on 1st January 20x4. At 31st December 20x4, the cattle have a fair value of 13,000 and Magna sold the cattle commission 2% would be payable, mean point of sale is 2%. This means 98% of 13,000 will be asset value at end of year. What's the difference between 10,500 and 13,000 into 98% because 2% we need to deduct? What's that? No, what's the value of 98%? 12740. So at this amount, we will record the asset and 2240 will be the gain. That's it for today. Thank you so much for your patience. From next week, we will conduct class on Tuesday and Wednesday. Instead of Monday, we will conduct class Tuesday and Wednesday for 1 week on.
6, 6, 11.
And
6
time,
to 9.
sir?
Was going to say Monday or Tuesday, whatever, that one class I can attend because I have exam on 6th and 8th, Monday and Wednesday.
So in next week, we'll be having 2 classes, one on Tuesday and one on Wednesday.
And the timing for next week will be
6 to 9, 6 to 9. Today I have to go for some car registration office and it's far from here. So that's why we conducted class 1 hour early.
Thank you, sir.